Hello and welcome to the Harwood Report for September 17th, 2018. I am Keith Harwood, the founder of Trade Academy. Let's do the disclosures before we do anything else. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures as they are important. All right, we'll go through it again today. So the most interesting stuff to me is still in the equity indices. There's been a little bit of chop here. There's a little bit of stuff going on. You know we've got issues in trade. These headlines are not really pushing their way through to the market aggressively. It's smaller and smaller reactions. We're going to look at the charts and think about the framework for trading these markets given what's going on today. I'll touch on bonds, the precious metals, and oil as well, because all of these things are being impacted in large part by global trade more than anything else. So it's all a big macro universe situation. So the first thing here is fear and greed is showing 70. I always look at this and I want to point out right now that this is overstating where I believe fear and greed really is in the market. And what I mean by that is that they're saying extreme greed out of stock price strength. Does this look like it's an extreme high? No, it's at a 3-month high. An extreme high is what we saw in January or even October, November of last year. This is less than half that level. So for me, not showing extreme greed. This is showing some greed. Put and call options, it's greed, but not extreme greed. Sure, maybe you could say that there's extreme greed here, now that this thing has just been drifting lower, of course. But a junk bond demand, is that really the main driver of the markets right now? No, I don't believe so. Safe haven demand looks pretty neutral to me. This looks maybe like it could be a little bit greedier. You could call this extreme greed given where we're at. But at the end of the day, very neutral VIX, very neutral summation index, if not a little bit fearful there. So overall, I don't think we're worried, or we should be worried about a level in the 70s right now. I'm worried about a level that gets into the 80s, because a level that gets into the 80s either means stock breadth, everything else, VIX gets crushed, stock breadth catches up, and all these things that are already extreme greed probably actually go into a level where I would consider them almost an extreme greed level. Then we have to worry about an overbought situation. Until then, it's just maybe a little bit frothy of a market in the short term. So let's talk about that short-term froth. SPY is sitting at the highs. This is not bearish yet. We've retested the 20-day moving average last week and bounced off of it. Looks like we may retest it again this week. That would be about another $1 away in SPY. Frankly, the little move we had today is probably already enough to call it a little bit of a retest. We are in chop mode. The trend is still up. So if I'm looking for a drive, I'm looking for an upward move. The previous high is 291.74. If we start going a little higher, particularly if we get through that level, which is about $2 away, this gets a very bullish, explosive upside potential. If we get lower, if we get below the 20-day moving average and close there, we've got that pullback to the 50-day moving average in our sights. That's basically a $4 move to the downside and an unknown move to the upside. I'd rather play for the upside in the options landscape because that's where I can get real leverage to pay. Speaking of which, let's look at the VIX. The VIX is not as cheap as I would expect it to be given where the market is. What does that mean? I've talked about this before. I'm just say it again. People are hedged and hedging because they're worried that something in the trade war situation is going to go bad. So if they're hedged, dips are basically bought. They're not having to stop out of positions, so they don't sell into sell-offs. They just sit on their hands. And into rallies, they're looking to roll up their positions or maybe sell some calls. That could create a VIX collapse if we start to get a rally, because now all these people that have been hedging by buying puts have watched that money go to the wayside. And they start saying, well, you know what? Fine. If we go up another 10%, I'll just sell out my position, so I'll sell some calls that are out of the money. That creates that VIX crush. That's a little bit more of an interesting setup then. If we get a VIX crush from call sellers when we get an explosive move to the upside, if and when that happens, then that actually could set up some really interesting counter moves to the downside, because maybe we get a little too overbought and have a quick pullback after a spike. That's the stuff I'm looking for in the coming weeks. In terms of this week, I think we look for a grind higher that becomes potentially explosive on a move through that prior high. Qs are not expect it to explode higher this week unless something comes out fundamentally like, hey, China's coming to the table, we're not imposing tariffs, and they're backing off on something. That should be explosively bullish because it means we're getting closer. Right now, this market just looks like chop. If we get below the 50-day moving average, I'm bearish. If we skip back above the 10 and the 20-day moving average, I think we can start looking on the bull side again for a run to 187. Either way, it's not a big mover because below the 50-day moving average, I think we're looking for the 100-day moving average. Above the 10-day moving average, I think we're just looking towards recent highs, but SPY probably breaks out first. So the Qs with vol where it is, I don't think it's a big play. There are ways to play it. I'll talk about that, or I did talk about that in the premium newsletter that I've already posted a little earlier today. There are ways to make that work for a run back towards highs without vol exploding, maybe even with vol getting crushed, particularly in the tech sector. So let's see how this stuff goes. If you want to know the trade, go to the newsletter, sign up for free for a week, get that 1 week free trial, and then after that, if you like it, you can just stay signed up, and if you don't, I'm not going to be offended. We'll move on without you. But, I think you'll enjoy what you see out of the premium newsletter and the premium midweek update. Let's go from the Qs to SMH because that's a big component. Semiconductors are a big component of the tech. And really last week, it looked like things could get really bad. And then we just got a full recovery. So that move on the 12th, big crush recovery and then run the next day. This tells me that each time we get to these lows, there's a buyer there. And each time we get to the highs, there's a seller. But, when we go to the lows, we tend to move back to the highs. That should give a tailwind to the Qs if that trend continues to repeat. Over to IWM, which has been, I think, a big indicator of what's going on all in the market. And if you look at the last week and a half, the answer is nothing. We're getting close to some of the previous highs, so maybe this could create a little bit of a washout, especially if we get below the 50-day moving average there. But we're just chopping in IWM. Watch IWM for a breakout. I think we're going to get some good movement in IWM, and then if that gets a break to the downside, that may be our signal that SPY and the Qs are going to liquidate as well. And if it gets a breakout to the upside, that may be our signal that the world is going to explode higher. So I'm just going to be kind of watching this. We're in that chop range for IWM right now. But there are some trades actually in options land given what is going on in the volatility landscape for IWM. Just want to note that. In terms of TLT, we're still kind of in this, in sort of that same idea. We may break below this previous low and then have about $1 downside, or we may bounce and go back up to 122. That there's more upside than downside from here. The probability move may be to the downside. We have to keep in mind, though, that the Bank of Japan has their meeting this week. That could impact both the dollar and global bond yields. So we have to watch that along with everything else going on the global macro trade front. So TLT is a little bit of a question mark for me of what direction we go from here. Maybe more of a wait and see trade. If we get back above the 10-day moving average, maybe that drives us to the 122 level. Staying below the trend maybe pulls us down another $1.50 from here towards 117. But it's unclear to me. There's not a great R&R to a long or a short here. Moving to the precious metals. So gold is kind of chopping here while dollar yen is testing highs. So here's the key with the dollar yen. Bank of Japan's this week. That's going to move dollar yen. And if that moves it to the upside, I think gold can take another big leg lower. Gold vol is at the right price for me to look for a trade here, even without that fundamental input. So right now with gold chopping, but dollar yen at an inflection point, I think there's a trade here for movement at a minimum. Okay. Again, I talk about that more in detail on the newsletter. I will tell you right now that gold miners are a little less interesting to me. It could be setting up a short squeeze if dollar yen gets hit. Same idea with silver, but the vol levels there are just not as attractive. So I'll show you on this what I'm talking about. So when we look at gold right here, 9.59 is about as low as we get. 9.4 really right here has been kind of a good floor. We touched basically 8.5 to 9 there for a couple days, but really it's where we're at is kind of the floor. GDXJ vol came up when we had the big explosion down. That has some room to fall. And silver has a little bit more room to fall as well, down to potentially 15.5 or at least 16, and we're at 17.5 right now. So given that those, I think, have a little more room to fall, that makes gold the more attractive play from a long options player perspective, especially if I'm thinking that this week's Bank of Japan decision could cause some big volatility in the precious metal sector. Then I look for the opportunity of which precious metal has the most leverage given where the marketplace is. And finally, we're going to go to the energy sector. I'll start with USO and just show you basically it's chop city here in USO. Very tough to find a direction here, but this little coil should get a breakout. You can sort of see the wedge forming here, short-term wedge, longer-term wedge, pennant, not wedge technically, but whatever. You can see that this is starting to get that coil. That could create some explosive movement, especially if there are any changes on the trade front or something comes with another hurricane or something crazy like that. So that could create some volatility in this landscape, and then that would certainly set the tone for the energy stocks. They did bounce back as I was looking for last week, but now we're kind of in the middle of the range. Still maybe on the lightly bullish side for XLE, and then OIH I think has the squeeze potential. So that's where I'm looking for the squeeze potential play if oil does decide to firm. We go to OIH for that because you can see how much that's underperformed, and this long downtrend could easily get breached. I mean, first target clearly on the upside would be the 50-day moving average that we've held 3 or 4 times here in the last couple months. But if it gets through that, I'm not sure that the 100 and the 200-day moving average provide a lot of resistance. I think we could just spike all the way up into the 27.5 range on a move through 25. So it's a spot where, if I'm using this with options, I'm looking for a play that can get me some money at 25. But then I can roll up, basically finance a trade and look for that potential explosive move that would be another 10% higher than that in relatively short order. So that could be a spot to get a lot of leverage really quickly if oil starts to firm. Oil hasn't firmed enough. It did get a good spike last week that created some money-making opportunities. The next leg higher would be the one that could really drive it. All right. That's it for the free stuff. If you want more information, go to the Harwood Report. Sign up now. The newsletter is filled with ideas and implementation of those sort of technical setups that I'm talking about and some of the fundamentals that I'm looking at and worried about. And then I do a Wednesday update for premium subscribers as well. So they get an idea of how I'm going forward from that point. It's free for a week. That's a good deal. $49 a month. That's a good deal, frankly. So I think you owe it to yourself to try it out when it's free. I always like to take free trials on anything and then see if it's adding enough value to my trading to justify me continuing along with it. So I urge you to do the same. And again, if you have any questions, you should feel free to email me, keith@tradeacademy.co, or call me 312-600-8004. Thanks for listening, and I look forward to seeing you all in the premium newsletter. And for those of you that elect not to, I'll remind you again next week after we do some more free stuff to sign up at that point, because there's some value here, I think. Thanks again, folks. Have a great afternoon.